Hi everyone, I am Sneha Jain, the founder of Veltrus Capital Services, a full service boutique firm, wealth management boutique firm. Welcome to our first update on markets. Today we have with us a fantastic panel to discuss the recent market volatility and how the upcoming elections might impact it. With me are Karthik, Shubham, and Aman from my research team. To set the context right, if you look at Nifty's behavior in the past 1 month, it has been really volatile. So, I'll tell Karthik to dive in and tell us why he believes what is feeding this market volatility, and if he can, tell us a little bit about what to expect.
Absolutely, Sneha. Thanks for introducing me. To take everyone through the market volatility that we are witnessing is primarily driven by three factors. That's the FII flows, the earnings, and the valuations. Now, primarily, if we look at FII flows are influenced primarily by the yield, and with the US offering a higher yield, FIIs are pulling their money out from Indian markets and naturally moving towards that. But on the positive side, if we look, DIIs are still investing in India. But overall, currently, we are seeing an outflow. Also, there is a lot of volatility and instability regarding the oil prices. So, more than 30% of India's energy demand is driven by oil pricing. And with oil prices rocketing more than $95 per barrel, it is but obvious there is a lot of pressure on margins. So now I'll have my colleague and Aman to please talk about the market sentiment, the earnings, and take us through the management perceptions on this.
Yeah, sure. Thanks, Karthik, for that. And excellent question. So, the earnings have been volatile this quarter. If you look at it on a quarter on quarter basis, they have been subdued for the most part. Overall, on a yearly basis, they have really grown significantly. However, the management have actually revised their earnings estimates. So, they have revised the previous estimates of 10 to 15% growth to now down to 8 to 10% growth. Now, on a relative basis, if you see, the ITs have actually weighed down the sector. They are also the heavyweights in the Nifty 50 index, as opposed to autos and banks that have performed really well in both in terms of revenue and profit after taxes. Uh, so, moving on to the valuations, even the valuations. So, if you look at the price to earnings chart for the historical data, right? We have taken a 10-year data set here. If you really look at it, the three indices that we have considered, the Nifty 50, Nifty Mid Cap, and the Nifty Small Cap, all three of them trade near their long-term medians. So that essentially shows us these indices are fairly valued, if not undervalued. However, due to the market volatility and reducing earnings in the current quarter, we can see further correction here. One interesting thing is we have the elections coming up next year, and it is only going to feed into the market volatility. So we also have with us Mr. Shubham, who would shed some light on the effect of elections on the markets. Over to you, Shubham.
Yeah, thank you, Aman, for this wonderful explanation. And yes, you are right. As you said, some sectors are performing very weak, and some sectors are really doing very good. So at the current scenario, there are some people who are expecting that at the current market price, what is around 19,200. Some things that the market can go to 21,000, and some people are expecting that the market can fall to 18,000. So we have collected some data of the Sensex return of 1 year prior to election and 6 months prior to election. So this will give us a brief explanation about how market reacts to the election years. So for example, from 1990 to 1991, the election year, the Sensex has gained around 63%. And 6 months prior to election year, that is November 1990, the Sensex has given 9.28%. At the same, if you will see at the 1996, 1 year difference of 1 year before election, the market gave close to 20.88%, and 6 months before the election, the market gave around 9%. Then suddenly, if you will see at 1998, 1 year return was negative 1%, and 6 months difference was negative 6%. Now the major concern is, as you all know, that if whenever the government is very volatile, the market reacts in a very negative way. And in the same scenario in 1998, the government was very volatile, and you can see the reaction of the market. The market, at 1 year it was negative 1%, and 6 months before the election it was negative 6%. So this tell us that whenever the government is very volatile, you can't expect market to rally, right? And if you will see again on 1999, the 1 year difference was 51%, 6 months was 27%, which is which is exceptionally good. For 1 year return of Sensex was close to 90%. See what happens whenever the government implements their strategy, their schemes, and if they start doing good, market reacts in a very positive way. And again 2009, if you will see, 1 year difference was minus 35%. I know that all of you know that this was because of the Lehman Brothers crisis. But then if you will see the 6 months before the election result, it was positive 16.50%. And as I said you, until and unless there is some volatility in the government, there were market reacts very positive. 2014 again 1 year difference was 14%, 6 months again 5.60%, and recently in 2019 1 year return was 11.59%, and 6 months price difference was 11.28%. So the conclusion behind analyzing the past government election result is that until and unless there is a volatility of the government, the markets always react in a very positive way for the short term and as well as for the long term. That's all from my side.
Thank you, everyone. I think that was a very interesting, synopsis by the team. So, just to conclude, the main points, as Karthik, Aman, and Shubham mentioned, for the volatility in the recent months are: one is the US yields have caught up to Nifty earnings yields, and that's why we see the volatility. The Nifty 50p is near the historic median, so there is more room for potential expansion. And even the small cap and mid cap are in the similar range. There are volatile earnings. A lot of companies have reinstated their earnings, and we see there is lower earning revisions, and thus it is weighing down the broad market index. And also the upcoming elections, there is a little, anticipation of which government will come in, and that's why there could be some volatility in the shorter term. But the bigger question is, right, for most investors, what do you do in the next 1 year or so, and how do you put in your portfolios to kind of ensure that there is lower volatility in your overall portfolio? So yes, if you're a long-term investor, that is, if you're a 5, 7, 10-year kind of an investor, I think you should do nothing but stay invested and keep adding investments. India is placed beautifully in terms of the investment landscape, and there are a lot of opportunities to make your money work for you in the longer term. But if your horizon is fairly short, then of course you are going to see a lot of volatility. And if it's a 2-3 year kind of a horizon, a multi-asset approach will be best suited, because we are going to see a lot of volatility in the next 6 months is what we anticipate. Also, if you're just entering into the markets, of course a staggered approach will just help you to take to dampen the swings in the portfolio, so that you don't see a lot of volatility or you don't see a lot of drawdown in your overall portfolio. So if you're just entering in, a staggered approach or STP route may be a very, very good way to enter. In terms of valuations, of course, for the next 6-9 months or 1 year, we do believe that large caps are actually may offer better value. That concludes this session. Thank perspectives, and thank you to our viewers for tuning in. We will be back next month with another outlook and another view. Thank you.